Hello everyone, Steve Lentz here with Discover Options. This is the market likelihood report that will be posted in the Prepared Mind blog for Discover Options. You could go to discoveroptions.com, click on the blog link at the top and see Frank Fahey's Prepared Mind report. Lots of great information there. He includes a huge readout of material to prepare you for the earnings coming up here. He has a candidate list for double calendars. You might be interested for those of you options traders. Let's look at the technicals as it stood on Friday at the close. A couple very small range bars to cap off the week. And what we like to do here is look at the action and divide it between price action, trend, and the overbought and oversold condition. And so under price action, we have highs and lows that are lower than the previous day on Thursday. The true range, again, as I said, we're keeping it, we're just labeling this as underneath 1.5% for the average true range. In terms of a percent. The trend, we're above the 50-day moving average, and we're definitely in the overbought area of over 70. So you put all that together, and what we're going to do is go back in time and try and ascertain what the market did under similar conditions. So since 2000, how often has this same scenario occurred, and what did the market do? Now, some of you have been through this before with the previous posts that we've done. You can go ahead and skip to the end and take a look at the charts and everything. But for those of you just starting out, here's what we do. It's called edge analysis. And what we're trying to do is ascertain, like I just said, back in time, what did the market do when we had this same setup? What did it do? Did it go up typically? Did it go down typically? Or did it wobble in the middle? All right, and so what we'd like to do to determine that is that we look at the historical distribution of price just from a random perspective going back to January of 2000. What was the distribution? We're going to take this same technical scenario and we're going to go back and take a look at what the distribution of price was under these same conditions that we had at the end of Friday. Okay, if the two are different, if we find that this condition has a different distribution than what just the random historical distribution is, well, then there might be a tradable edge for us to take a peek at. Let's look at the general historical distribution of price and define our terms here. What I like to do is use volatility bands. We've set these up in 5, 10, and 15-day periods. Each band is measured one standard deviation from the close using a 20-day historical or statistical volatility number. Now later we'll go to some skew adjusted implieds as well. Log normally distributed, of course. Here's an example of 10-day bands using statistical volatility to determine it from the close. So these bands are located one standard deviation above and below the close. 10 days out. So here's the idea. We want to understand how often we're just going to draw these borders across, these bands across. And the question on the table is, did price go up and hit the upper band sometime in the next 10 days? Did it go down and hit the lower, or did it wobble in the middle here? Okay, let's take a look. Oh, is it going to let me do this? Boom, there we go. And we can move. Well, it went up and hit the upper band, didn't it, right there? You see that? Okay, now let's look at the next close. All right, we just draw these bands across. And the question will be, did price go up and hit the upper band in 10 days, go down and hit the lower, or did it wobble in the middle? And let's take a peek and see what it did. All right, it ended up kind of wobbling in the middle. It tried to go down right there and hit the lower band, close but no cigar, so in this case it hit neither. Now what we're going to do is, from every close going back to January of 2000, it's about 4,080 closes going back that far. For every close, we're going to record how often price struck the upper and the lower 5, 10, and 15-day bands. Okay, and then we get a complete readout of the general distribution of price in terms of how far it moved in either direction. And here is what we have. Let's just take a look at this. I just discovered this little, there we go. So historically, from January 2000 through the 15th of this year, of April here, it would go up and hit the upper 5-day band 29.5% of the time, the upper 10-day band 23.1, 22.9, and then the lower bands, almost 30%, and a little over 32% on the lower bands. So generally, you're looking at price striking these bands 23 to 30% of the time in general, but you can see the specific percentages here over the course of 4,082 signals. That's the historical distribution. Now we're going to look at the technical scenario. All right. Right there, we're going to seek to understand the distribution after our specific technical scenario. And here you can see we created the little arrows now, or I highlighted the bars that it occurred in, and I'm wondering whether the ATR filter was put in there. Maybe not by then, but I certainly did it in the final results here. And what we're going to do is, for each one of these, we're going to look at the distribution as it occurred at just the close. And then we want to know what the price distribution was if it penetrated Friday's high, or if it went down and went below Friday's low. That way, armed with that data, you can kind of go into Monday and kind of have an idea on the likelihoods if price goes above Friday's high, and as opposed to the likelihoods if price goes down below Friday's low. Okay, could be a big difference there. Now, before we get to those numbers, want to point out at Discover Options, we have a great continuing education program. If you're not ready for the full-blown mentoring that we offer, and we specialize in one-on-one options trading mentoring, and we have a great set of packages for you, starting at $99, going to $199, and then we have a package as well that it's 14 sessions and a futures session as well. That's a futures program that's 7 sessions. So, but we have this kind of in the middle program for those of you just starting out, or those of you advanced that really want to dive in deeper. Continuing education for $495 a year. It includes this list of items, but I want to draw your attention mostly to the archived inside wires. If you like some of the stuff that we do here, we've archived roughly, well, gosh, it might be pushing 350 sessions now of sessions I do every Wednesday or Tuesday morning at 11 Central live. We record those and archive them, but it's just areas of research. You can see a little list here, stuff that I've done, offset broken wing put butterflies, some analysis on various types of other skew adjusted market likelihood report that I'm going to get to here. We also review our core strategy reviews for the non-directional stuff. RSI credit spread trading, you can see there are lots of different topics that might be of great interest to you. 350 of those that have been archived. So give that a look. Give us a call, 847-816-6610, and dive deeper here. Statistical volatility, creating the bands. You saw the historical distribution up here. Let me get my little arrow. Check it out. Okay. The upper bands were struck historically that often. Now look at this. After our scenario is set up at the close, okay, the upper band in this specific technical setup over the course of 271 signals, okay, the upper band was only struck 20.7% of the time, which is a lot less than 29.5. That difference is almost 9%. Okay, so what we're saying is that this technical setup, all right, just at the close and looking at that only, price strikes the upper band a lot less often than normal. This technical setup would indicate that, in fact, all 3 of the upper bands get struck less often, although not that much less often on the 15. On the downside, it strikes the lower 5-day band just a squeege more often than normal, and then the lower 10 and the 15, 2.5% and 5%. Are those tradable edges? Not really. Let's look at what happens historically if price goes above the high. Okay, let me click. There we go. Oops, timeout. There. Boom. Now we're talking. Now we're talking here. Look at this. If on Monday price exceeds Friday's high, in that situation, we have 176 instances in the past where the same setup occurred, the high got broken, and you'll see here then the upper bands were struck 16, 18, about 20% of the time, far less often than historical, and you can see those negative differences there. On the downside bands, if it goes above Friday's high, okay, you can see the 26, 22, 24, less often, less often, and less often, a little bit by quite a bit here on the 10-day anyway, and the 15. So clearly, if it goes above Friday's high on Monday, you're looking at historically there's been less volatility. It is more often than not failed to strike the upper and the lower bands. Okay, so historically it would indicate there's a likelihood of less volatility both to the upside and the downside. No real directional bias here, by the way. It's just showing lower volatility in general. Let's go down to the, if it goes below Monday's low. Look at this. If it goes below Monday's low, the upper band is struck less often. The upper 10 and 15-day bands are struck a squeege bit more. Not much, but just a little bit. The lower 5 and 10-day bands are struck just a squeege bit more. Nothing huge to write home about, though. So clearly, the more, if it goes above Monday's or Friday's high on Monday, you have a little bit more of a likelihood that volatility will be less going in the future than what it has been historically. So that would lend itself well to options trading from a neutral perspective, selling premium primarily. Now, with that said, let's talk about the option traders. Here is the vol chart in option view. We have implied and statistical right here. All in all, you can see the averages at the top. Implied is higher than statistical over a 4.5 and 6 year average by quite a bit. All right, and so what we're going to do now is create the same bands using a skew adjusted VIX. Okay, now what that means is, now VIX is typically higher than statistical, so that means the bands are going to be generally farther out, and when they're farther out, they'll get struck less often. And that's why up here you have numbers that are lower than when we had bands using statistical volatility, right? Now with bands farther out, they're going to get struck less often, and so the historical baseline, the numbers are a bit less. Now let's take a look at the close. Time out. Just hit this. Whoa. There we go. At the close, clearly, look at this. Clearly we have instances where the bands were struck less often than historical across all 6 time frames here, 5, 10, and 15, upper and lower. If price exceeds Friday's high, just a second here, oops, all right, there we go. Larger numbers, look at this, outstanding. If price goes above Friday's high, the upper band over 176 times, the upper band was only struck 8% of the time, 8.5%. 15 was about 7.5% of the time. Not very often. That's less than 1 in 10 that the upper band gets struck. Okay, now the bands are farther out than statistical, we understand that, but remember, this is skew adjusted, meaning that the call side is closer in than the put side, the downside, which is further out, right? Puts have higher implied than the calls, so the call side being skew adjusted, the upside is closer in to the current price, and the put side, the downside, is farther away. Now on the downside bands, look at this, 8%, about 11, and then it hits the lower 15, 24.4, quite a bit more than that. Look at that. That's kind of an anomaly that's sitting there. Interesting. And then we finally get if price exceeds Friday's low. If it exceeds Friday's low, we still have some low numbers here, 1 in 10. Now on the lower bands are struck a little more often than certainly if it goes above the high, but still slightly advantageous. So all in all, For the premium sellers, you would favor a price action where it exceeds Friday's high. And then statistically, it tells us that at least historically, the market has been more often than less volatile in that situation, as opposed to not going above the high. Here are the volatilities. SV is 11.2. The upside volatility was at 12, and the downside skew adjusted VIX was at 15.2. Now, if you were to put on a one standard deviation condor using these numbers, just for grins, what would it look like? Okay, let's take a look at that real quick and we'll wrap it up. So what you do is you use the 12, I think that was, wasn't it? Yeah, 12 and 15.2. So we're going to put a 12% volatility to determine the one standard deviation. That puts us out at 2130. Do our little credit spread for this condor. And then we put, what do we say, 15.2 for the downside to create this credit spread, and there you go. And when you model this thing, there you go. You have then a condor, and you'll note that the short strike of the condor here in option view is a little bit within that standard deviation, and on the downside, it's just a little bit, well, it's right on the edge in that sense. So it's kind of skewed a little bit to the left to take advantage of the skew modeling from the VIX using the SIBO skew symbol. All right, and what you can do is then, knowing that it'll hit one of these borders just one time in 10, what you would do is calculate your risk versus reward. It looks like you might lose twice as much if it hits one of these edges than what you're trying to gain here. And so if it hits this side 1 in 10 and this side 1 in 10 and the other 8 stay in the middle here, you can see clearly we have an edge because if you lose 2 times over here, 2 times over there, and then you make yeah, that's right. Then the other 8 times you make money here in the middle, you can see we have a clear edge. Okay, folks, I'm with Discover Options. There we go. Time out. There we are. Perfect. Trusted and proven. Call us at 847-816-6610. Thank you so much for joining me. We'll talk to you next week. Bye-bye.